ESG investing is arguably one of the hottest trends in the financial world right now. Though the term was coined in a 2004 report titled "Who Cares Wins?", the concept has been around much longer. By Q1 2024, ESG investing had skyrocketed into a global phenomenon with over $3 trillion in assets under management. But despite its popularity, there are some fundamental problems we need to discuss. In this video, let's talk about ESG investing. So what exactly is ESG investing? It's a way to invest in companies that are supposed to do good things for the environment, society, and their own governance. Think of it like this. You are choosing stocks or funds based on how green a company is, how well they treat their employees, and how transparent they are with their business practices. The idea behind ESG investing is awesome. Who wouldn't want to support companies that are helping to fight climate change, promote social justice, and have ethical leadership? This type of investing is sometimes called responsible, sustainable, conscious, or impact investing. The process of considering these ESG factors in investment decisions is known as ESG integration. When you mix traditional investing that focuses on financial returns with ESG criteria, things can get complicated. It's important to understand that ESG integration is just one part of the decision-making process, not the end result. This sometimes means that if a fund's objective allows, a portfolio can still include companies with negative ESG characteristics if the overall risk return is attractive. For retail investors, the easiest way to get into ESG investing is through an ESG fund. And these funds aim to maximize financial returns while pursuing its ESG investment strategy. They typically use one or more of the following screening processes. Number 1, positive screening. Positive screening includes companies that meet specific ESG criteria, for example, only investing in the top 10% of companies in an industry ranked by carbon emission intensity. The example that I can give you is BetaShares Global Sustainability Leaders, ETHI, which selects companies that use 100% renewable sources to generate power. This might mean choosing investments that stand out based on ESG factors, even if they don't always outperform their peers financially. The second type is negative screening. Negative screening, on the other hand, excludes companies that don't meet certain ESG criteria based on their business activities and product involvement. For instance, a fund might exclude all companies involved in gambling. Within negative screening, there is also norms-based screening, which eliminates companies that don't adhere to certain standards of business practice based on international norms like the United Nations Global Compact. These can include corporation behaviors such as human rights violations, forced or child labor, bribery, corruption, or other criminal activities. Using these screening methods, ESG funds aim to align investment choices with the values and priorities of investors who care about environmental sustainability, social responsibility, and ethical governance. ESG investing has 3 main benefits. Number 1, you can make an impact. As an investor, you can support causes you care about, like reducing carbon footprints and promoting fair pay practices. This helps create a more sustainable future. Companies that adopt ESG principles can attract more investors and contribute to a better world, leading to significant economic returns. Contrary to the belief that ESG investing hurts returns, a meta-study of over 2,000 analyses from 1970 to 2014 showed that nearly half found a positive relationship between ESG and corporate financial performance, with only 11% finding a negative correlation. Well, ESG investing sounds great. The reality can be a bit messy. Let's talk about some challenges in this field. Number 1 problem is the standardization issue. Different funds and companies can have widely different criteria, making it hard to know if your money is really making a difference. As ESG metrics are not yet fully standardized, investors must rely on company-defined figures to serve the growing pool of ESG investors and the increasing demand for data. Index provider rating agencies have created their own ratings to evaluate ESG factors. The 4 major rating agencies for ESG that dominate the current market include MSCI, Sustainalytics, RepRisk, and the newly emerging ISS. Some agencies give the rating scale from AAA to CCC, with AAA being the best, such as MSCI. Some give the ratings on a 0 to 100 scale, such as Sustainalytics. Unsurprisingly, the ratings given by different agencies will come out with big disparities. Similar to the lack of global standardization, there is no generally agreed definition of an ethical or responsible investment fund. Consequently, some funds that label themselves as ethical may actually include exposure to fossil fuel producers. In contrast, others can include companies engaged in various other activities such as gambling or tobacco. Another hidden problem due to the complexity of the negative screening is that investors who seek screened portfolios often express their desire for screening as a topic area, such as screening tobacco from a portfolio. There are multiple potential thresholds for what it means to be involved in tobacco. Should a business that generates 2% of revenue from tobacco-related products count as evolved? Or a business that is a significant owner of a tobacco manufacturer but doesn't produce tobacco directly considered evolved? The second challenge is the transparency issue. ESG reporting can be challenging as companies don't always have the required software, data, or a sound understanding of these metrics. More importantly, some factors determine whether a corporation complies with ESG are not fully quantified. Experts like the Global Task Force on Climate-Related Financial Disclosures have increased disclosures since 2015, but are still insufficient for investors. This also leads to another problem. Companies with better ESG reporting may trade at a premium compared to those with inferior standards. Another problem, which could be the biggest problem of all, is the greenwashing. Greenwashing occurs when companies claim that their products are more environmentally friendly than they actually are. In other words, they are using ESG as a marketing tool. For example, a super fund could say that it doesn't invest in gambling firms. However, on closer inspection, it may actually invest in businesses that earn a revenue of up to 20% from gambling. So, as investors, it's important to check what a fund's product disclosure statement says about investing and what it is actually doing. In the first quarter of 2024, global sustainable funds attracted nearly $900 million in new investments. Europe is the largest market for sustainable funds, with 5,581 funds, 73% of the total. In Australia and New Zealand, there are 261 sustainable funds, 3% of the total. There are more ethical conscious funds in the superannuation funds and managed funds. This means it might be tricky for retail investors to compare ESG funds. Things that you should ask yourself before purchasing the funds, like, what ESG factors matter most to me? Does the fund match that? Check the methodology and holdings to ensure they align with your expectations and are not greenwashing. Some ESG funds charge higher fees, especially if it is actively managed. Consider if the management fee is worth the ESG benefits. Alright, I hope this video has helped you understand the pros and cons of ESG investing. It's a complex topic, but it's important to be informed. Are you an ESG investor? What is your process of finding the best ESG fund? Drop a comment below. My name is Irene. I'll see you next week.